The US loses $600 billion in taxes every single year. Not from some elaborate offshore scheme or corporate loophole, from regular people just not reporting all their income. And that's only the beginning. Today, I'm breaking down every type of tax evasion, from the stuff your neighbor does to the strategies that cost governments hundreds of billions, starting with the one almost everyone has done. Underreporting income. If you've ever been paid in cash and didn't report it, congratulations, you've technically committed tax evasion, and you're not alone. Underreporting income is the single biggest driver of that $600 billion tax gap, and it's not even close. Here's why it's so widespread. Cash-based businesses like restaurants, salons, and construction companies underreport income at 3 to 4 times the rate of salaried workers. If the money is hard to trace, the temptation is obvious. Around 15 to 20% of self-employed individuals significantly underreport what they earn, and the gig economy has made that number almost impossible to police. But here's the kicker. It costs the IRS roughly 55 cents to collect every single enforced dollar, meaning statistically, if you dodge an audit, you come out ahead. The system is so inefficient that cheating it is almost rational on paper. A lot of people don't even think of this as real evasion. Freelancers, Uber drivers, people selling stuff on Etsy, they'll argue the tax code is confusing, that they didn't know what to report. The IRS absolutely does not care. Unreported income is unreported income, whether it's $500 or $500,000. But if underreporting what you earn sounds too simple, wait until you hear how people inflate what they spend. Inflating deductions. You've heard someone say it. I write everything off. Your uncle, your coworker, that guy at the barbecue who definitely doesn't have an accountant. And honestly, most of them are lying on their taxes. They just don't call it that. Here's the thing. Charitable donation overvaluation alone drains $4 to $8 billion from U.S. tax revenue every single year. That bag of old clothes you dropped at Goodwill, worth maybe $40, but people claim $2,000 and nobody blinks. Business meal deductions are even worse. Around 40% of them are inflated or completely fabricated. Your client dinner at a steakhouse is one of the most audited line items in existence. But the real king of this category is mileage. False mileage logs are nearly impossible to disprove because individual trips almost never have documentation. You could write down 30,000 miles of business travel in a notebook, and the IRS would need a full investigation just to challenge it. Most people don't think of this as crime. They think of it as being smart, and that's exactly why it works. But inflating a few deductions is child's play compared to what happens when you move your money across international borders. Offshore, tax havens. This is where tax evasion stops being something your neighbor does and starts being something entire countries are built around. Between $21 and $32 trillion in private wealth is sitting in offshore accounts right now. That's not a typo. That range alone tells you how impossible this is to track. 5 tiny islands, the Cayman Islands, British Virgin Islands, Bahamas, Jersey, and Guernsey account for roughly 40% of all identified offshore tax avoidance structures. These places have populations smaller than most cities, but move more money than entire continents. You probably heard about the Panama Papers back in 2016. That leak dumped 11.5 million documents from a single law firm, Mossack Fonseca, exposing over 214,000 shell companies linked to politicians, criminals, and billionaires across the globe. But here's the thing most people miss. A huge chunk of offshore accounts are technically legal. The difference between tax avoidance and tax evasion often comes down to whether you filled out the right form. That's it. Trillions of dollars in concealment, and the crime is literally paperwork. The estimated annual global tax revenue loss from offshore structures sits somewhere between $427 and $600 billion. The fact that the range is that wide tells you everything you need to know about how well this is being policed. But if hiding money in a tropical bank account sounds complicated, wait until you see what happens when people start building fake companies to do it for them. Shell companies. Here's a fun fact. There are somewhere between 4 and 6 million active shell companies on the planet it right now. And the problem isn't that they exist. The problem is that roughly a third of them exist specifically to hide money from tax authorities, while the rest are completely legitimate businesses doing completely legal things. That's what makes shell companies such a nightmare to police. On paper, they look identical. A shell company used for tax evasion has a registered address, official documentation, and real banking relationships. So does a shell company used for legitimate liability separation or investment holding. You literally cannot tell them apart without a full forensic investigation, and nobody has the resources to investigate millions of companies. But here's where it gets really interesting. You don't need to look overseas for this. Delaware alone registered approximately 1.2 million new shell companies between 2015 and 2020, with an estimated 15 to 25% involved in significant tax evasion. America's most corporate-friendly state is pulling double duty as a tax evasion factory, and the scale gets absurd. A single shell company network uncovered in 2018 involved over 1,200 entities spread across more than 15 countries, concealing roughly $2.2 billion in tax liability. One network. The U.S. finally passed the Corporate Transparency Act in 2021, requiring beneficial ownership disclosure, but the actual reporting rules didn't take effect until January 2024. So for 3 years, the law existed on paper while shell companies kept operating in the shadows. And internationally, a shell registered in one country can still obscure ownership in another with zero consequences. Coordination between nations remains embarrassingly weak. But if shell companies sound complicated, wait until you hear about the corporate tax scheme with the most ridiculous name in financial history. Double Irish with a Dutch sandwich. This one isn't really evasion. That's the problem. The Double Irish with a Dutch sandwich was a tax structure that let multinational corporations pay 2 to 3% on billions in revenue. And it was completely, entirely, maddeningly legal. Here's how it worked. A company routes its profits through an Irish subsidiary that exploits intellectual property loopholes. Those profits then pass through a Dutch holding entity for tax deferral. Then they loop back to Ireland, tax-free. A perfect circle. No single country's law is broken at any point in the chain. Apple used this structure to shave an estimated $10 to $15 billion off its tax bill over roughly a decade. Google, Facebook, Amazon, Microsoft, all running the same playbook. Combined estimated avoidance across those companies? Somewhere between $50 and $100 billion. No documents were falsified. No income was hidden. It was pure legal architecture, and regulators couldn't do a thing about it. Ireland closed the loophole to new entrants on January 1st, 2015, but existing structures were grandfathered through the end of 2020, and successor schemes have already emerged because of course they have. But if corporate loopholes feel abstract, the next method is way more personal and way harder to trace. Cryptocurrency concealment. This one hits close to home for a lot of you, and you know exactly why. An estimated $14 billion in crypto gains went unreported to the IRS in 2023 alone. And that's just what blockchain analysts could actually identify. Here's the thing. Less than 10% of crypto traders are properly reporting their transactions. The reason is simple. When you send crypto from one wallet to another, there's no bank generating a report, no third party notifying the IRS. It's just you, your wallet, and your conscience. Traditional bank transfers leave a paper trail a mile long. Crypto wallet transfers? Silence. Then you've got privacy coins like Monero, which represent a small but significant slice of crypto activity. These coins are structurally designed to resist blockchain tracing. Their entire architecture exists to make transactions invisible, and people are absolutely using them for exactly the purpose you think. But here's where people get dangerously overconfident. Decentralized does not mean untraceable. Blockchain analysis has gotten absurdly effective. Chainalysis and similar firms have helped the IRS recover billions in crypto connected to fraud, ransomware, and unreported income. The IRS is slower than the technology, but they are catching up. And when they catch you, they don't just want the taxes. They want want penalties, they want interest. Sometimes they want prison time, but individual crypto traders hiding a few thousand in gains? That's nothing compared to what multinational corporations pull off with transfer pricing. Transfer pricing manipulation. This one is arguably the most expensive scheme on this entire list, and almost nobody outside of accounting circles talks about it. Transfer pricing manipulation is a major driver of what's called base erosion and profit shifting, a collection of tactics that cost governments somewhere between $100 and $240 billion every single year. Let me explain how it works. Say you're a massive tech company. You have a subsidiary in Ireland where corporate taxes are low and your main operations in the United States where taxes are high. You want your profits to show up in Ireland, not the US. So what do? You have your Irish subsidiary own your intellectual property, your brand name, your logos, your patents, all of it. Then you charge your American division a massive licensing fee to use that ICP. The money flows from the high tax country to the low tax country. Profit disappears from one balance sheet and reappears on another. And here's the kicker. Both companies are you. You're literally charging yourself. Apple did exactly this. In 2016, the European Commission ruled that Apple's Irish tax arrangements were illegal and ordered Ireland to recover $14.5 billion in unpaid taxes. The result of Apple's structure? An effective tax rate below 2% on billions in revenue. And enforcement is basically a nightmare, because here's the thing, there's no real market price to compare against. What's the fair price for licensing your own brand name to yourself? Nobody knows. There's no objective answer, and that ambiguity is exactly where corporations live. This isn't some rare loophole either. Roughly 60 to 70% of internal transactions among major multinationals involve some form of transfer pricing. It's not the exception, it's standard operating procedure. But if you think corporate level schemes are the only game in town, wait until you see how individual employees get in on the action. Illegal salary diversion. Most people hear salary diversion and picture some Wall Street executive funneling millions through a fake consulting firm. And sure, that happens, but this scheme is way more common than you think, and the mechanics behind it are genuinely clever. Here's how it works. A business owner pays you a $10,000 consulting fee, totally legitimate on paper, but then you quietly return $7,000 of that back to the owner in cash. The business claimed a $10,000 deduction, you only actually received $3,000, and the $7,000 that circled back, it never existed on any tax document. The tax liability just vanishes into thin air. This circular payment trick is one of the oldest forms of tax fraud in the book, and it scales fast. The IRS estimates that the overall tax gap, the difference between what's owed and what's actually paid, exceeds $600 billion annually. Schemes like salary diversion are a significant chunk of that number, especially among small businesses and cash-heavy industries where paper trails are easy to manipulate. But here's where it gets interesting. The tools have completely modernized. Cryptocurrency wallets and shell companies have made the money trail significantly harder to follow. The concept is identical, but the digital infrastructure adds layers of complexity. The IRS responded by pouring resources into crypto tracking and hiring specialized agents. Their enforcement budget has been climbing steadily, and circular payment schemes are squarely in the crosshairs. And the biggest misconception? This isn't just a rich person's game. Mid-level managers and small business owners use versions of this constantly. But if you think circular payments are sneaky, wait until you see what people do with trusts. Sham. Trust twigs. Here's something that'll bend your brain. A sham trust and a legitimate trust are the exact same document. Same legal forms, same structure, same signatures, same everything. The only difference is why you signed it. That's it. One piece of paper is perfectly legal estate planning. The identical piece of paper is a federal crime. The distinction is pure intent. And intent is almost impossible to prove until someone gets greedy enough to establish a pattern. And people get greedy constantly. The IRS has flagged abusive trust arrangements as one of its dirty dozen tax scams for years running. These aren't edge cases. They're so widespread that the agency dedicates entire enforcement campaigns to hunting them down. A legitimate financial instrument mass-produced as a tax evasion vehicle. But here's where it gets really dark. There are professionals who sell these things. Promoters who charge anywhere from $15,000 to over $100,000 per setup. Marketing fraudulent trust structures employers to wealthy clients like it's a premium consulting service. It's an entire industry built around packaging tax fraud in a nice binder. The scale is staggering. The IRS has pursued hundreds of abusive trust promoters and their clients over the years, with individual cases recovering tens of millions in unpaid taxes, penalties, and fraud charges. And those are just the ones that get caught. And here's the kicker. When these cases actually reach prosecution, the IRS Criminal Investigation Division maintains a conviction rate around 90% across tax fraud cases. Courts have gotten extremely good at identifying fraudulent intent. The problem was never proving it in court. The problem is catching someone in the first place. But if you think moving money through a fake trust is creative, wait until you see what happens when people send money on a round trip across international borders just to pretend it belongs to someone else. Round tripping. This one is almost beautiful in how stupid it is. You take your money, send it to a tax haven, and then bring it back home disguised as foreign investment. Same money, same owner. But now it's wearing a fake mustache and qualifies for tax benefits it was never supposed to get. And this wasn't some small-time trick. At peak activity between 2008 and 2015, round-tripping schemes involving China, India, and various tax haven intermediaries accounted for over $50 billion annually. A single network uncovered in 2012 involved $37 billion in fabricated foreign direct investment flows routed through Hong Kong. One network, $37 billion. All structured to look like legitimate cross-border investment. But here's where it gets interesting. India's government spent years actively welcoming this foreign investment before realizing something was off. Between 2012 and 2015, regulators reclassified $10 to $15 billion in previously accepted foreign investment flows. Billions of dollars the government had been celebrating as economic growth turned out to be domestic capital in a trench coat pretending to be from somewhere else. The defining trick is that round tripping exploits the gap between different countries' tax codes simultaneously. The same capital qualifies for tax benefits in multiple jurisdictions on a single loop. It leaves home, collects a benefit abroad, comes back, collects another benefit at home. One trip, multiple paydays. And now, modern round tripping increasingly uses cryptocurrency to obscure the circular flow, making an already difficult enforcement problem exponentially harder to trace. But if round tripping is money pretending to be foreign, the next method is even more brazen because it involves transactions that never happened at all. False invoicing. This one sounds almost too simple to work. Create a fake invoice, claim it as a business expense, reduce your taxable income. Done. But here's the thing. The simplicity is exactly what makes it so dangerous. Because when you scale it up, it stops being petty fraud and starts being an industrial operation. Let me explain how the sophisticated version works. You don't just fake one invoice. You build an entirely fictional supply chain. Fake vendors, fake deliveries, fake purchase orders, fake payment confirmations. Every single document in the chain is fabricated, and no goods or services ever change hands. Nothing is real except the tax deduction, and it's everywhere. The European Commission has estimated that EU countries lose around 60 billion euros per year to VAT fraud alone, and false invoicing is one of the primary mechanisms driving that gap. That's not a rounding error. That's a systemic failure baked into how business taxation works. But here's where it gets dark. A fake invoice between two businesses looks identical to a real one without deep forensic analysis. The paper trail checks out. The amounts look reasonable. Nobody flags it. Tax authorities are massively outnumbered by the volume of transactions they'd need to audit, which is exactly why these schemes thrive. Italy alone has uncovered multiple VAT fraud networks involving hundreds of millions of euros in fraudulent invoices, with some operations running for years before anyone caught on. And those are just the ones that got dismantled. The schemes that use a web of shell companies across multiple jurisdictions are exponentially harder to trace because every border the paper crosses adds another layer of bureaucratic fog. This is fraud that doesn't look like fraud. It looks like accounting. But if fabricating invoices is bad, wait until you see what happens when employers start lying about the people on their own payroll. Payroll tax Fraud. This one doesn't involve offshore accounts, shell companies, or teams of international lawyers. It involves your boss paying you in cash and pretending you don't exist. Payroll tax fraud costs the United States an estimated $50 to $70 billion every single year. Not from Fortune 500 companies, from small businesses. The most common method is almost embarrassingly simple. Pay workers in untraceable cash, never file payroll records, and act like the whole arrangement never happened. An estimated 2 to 3 million American workers receive unreported cash wages right now, and a shocking number of them have zero idea that anything illegal is happening. Construction and hospitality are consistently flagged as the highest risk industries for payroll tax fraud. Industries built on informal labor, high turnover, and cash flow. Nobody's setting up a subsidiary in the Cayman Islands. They're just handing someone an envelope on Friday and calling it a day. But here's where it gets genuinely infuriating. The victims aren't just the government. When an employer commits payroll fraud, they also fail to withhold their employees' income taxes. So when the scheme gets discovered, and the IRS has been ramping up criminal investigations into payroll fraud in recent years, it's the workers who get hit with back taxes, penalties, and interest. People who showed up, did the work, and had no idea their employer was pocketing the withholdings. Criminal penalties for the employer now range from $10,000 to $250,000 per offense, with potential prison sentences of up to 5 years per count. But the damage to the workers is already done, and that's the structural irony worth sitting with. This is simultaneously the most blue-collar entry on this entire list, and one of the most damaging by total dollar volume. The same fundamental logic that drives a multinational to route profits through Dublin, the same instinct behind every offshore account and every shell company, plays out every single week at cash-in-hand job sites across the country, just without the lawyers. Hide the income, dodge the liability. From a pocketed tip to a billion-dollar subsidiary, it's the same game at every level. If you enjoyed this video and want to see more, click the video on the screen now.